Hello and welcome to Tailored Talent. My name is Eric Walczykowski, the CEO of Bespoke Partners. I'm joined today by Adam Boone, our Chief Marketing Officer, and today we will talk about the current state of the market in 2024. Welcome, Boone.
Thanks, Eric. Awesome to be here. We're launching our new edition of the Private Equity Talent Report here. Just super pumped to share some of our findings.
Very excited about the report. As usual, very data-driven insights coming out of that. Speaking of insights, let's talk about the current exit environment and how that's impacting the shape of the PE market in 2024.
Yeah, right on. So the new edition of the Talent Report, this new market update, and specifically we're doing a deep dive on the exit environment this time around. And exits are on everyone's mind in the private equity sector. I think as everyone knows, we are the largest firm focused solely on software and SaaS in executive recruiting, and we specialize in recruiting for private equity-backed software companies. And it's just essentially been an exit gridlock for the past 18 months or so. The flow of acquisitions to strategics and other sponsors is basically cratered compared to the way it had been going previously. And of course, the IPO path is essentially shut down. And so that's had a huge impact on private equity firms. In the report this time around, we actually are getting some of the details around the impact this has in terms of the overall portfolio. First off, firms are just carrying a lot more portfolio companies than they were designed to do, right? If you continue to do deals, but have trouble exiting with your current portfolio, then you end up with a larger stable than you planned. And that, of course, means that your team that's assigned to support these firms is stretched thin. So everybody who's on a board seat or who is an operating partner who's advising the operators within these firms, all of them are just stretched thin.
I think it's an important point to make right here, which is when these firms were set up and they raised their fund, they were designed to hold a certain number of companies at a given time. And they actually have prescribed ratios between not only the deal partners and how many boards the deal partners will be sitting on, but also the operating executives and what the support ratio in terms of number of operating executives to number of portfolio companies is. And so when you're holding 25% more portfolio companies, it taxes the entire system.
100%. And the value creation plans and the investment thesis for each one of those portfolio companies is built around that model you just described, right? That ratio and the fact that you're supposed to be able to pay this kind of attention to the firms at a certain sort of volume. It's just effectively really stretched thin. That puts the value creation plans at risk. It puts the investment thesis at risk. And of course, it's going to end up lengthening hold periods and doing all kinds of things that you really don't want to see, especially when you're out trying to raise new funds and such. Investors, the LPs you're selling to, want to see that you're achieving the basic investment thesis of your fund and bringing your investments to an exit, achieving outsized returns. If you're not able to get to exit, then are you really that attractive to new LPs you're pitching? And then lastly, IRR, internal rate of return. It's the key metric that funds use to gauge their success overall. It's probably going to be drastically depressed because of a lack of exits and ability to post those outsized numbers.
Absolutely. And I think what we've seen in a number of our clients is they've decided that there are a certain number of companies they are going to exit this year, obviously at a profit. This is private equity. And so they're going to make money on it, just less money than perhaps they had prescribed to get the system going again, which will be very exciting to see. Boone, you hit the nail on the head. Bespoke Partners is the largest private equity software recruiting firm. Our job in this industry is to make sure executive talent gets in the companies in record time to execute on the value creation plan. Given the current state of the market and focus on exits, how's that changing our strategy as we look to place talent?
Yeah, 100%. So a couple of key things that we see and a couple of things that our clients are asking for, and I'm glad to say we're able to deliver on. So number one, we are super proud of our track record. The typical search firm out there is happy and feels like they've done their job when they place an executive and they get paid. Well, for us, actually placing the executive isn't where it stops. We want to see our executives be immensely successful and create awesome outcomes for our clients. So that means achieving the investment thesis. That means driving M&A and ultimately bringing the firm to exit. And I'm proud to say our placed executives have just been tremendously successful at that. Last count, more than 425 transactions across exits and acquisitions that they've driven at the firms we've placed them in, over $135 billion in enterprise value created. So super proud of that. Now, in particular, in this environment, with exits and the pressure to achieve exits on everyone's mind, we see a couple key skill sets that are coming to the fore, and we're helping our clients to find these executives. Number one, it's the M&A experts. A classic value creation plan is to take a platform company and then do the add-ons, right? Perform roll-ups, find other firms that are in the sector that can allow you to expand your market footprint or increase your wallet share and your customer base or ultimately bring new products to market. Right now, there are a lot of valuations that have come back down to earth from the really frothy times of a couple of years ago. And so there are bargains to be had. And so we're seeing a lot of interest in the experts we can bring to the table who can drive that M&A activity. And the case there is not only implementing the strategy and getting the deal done, but it's also integrating the new acquisition into the platform so that you can execute on the value creation plans and really, really grow. A couple other key areas of skill sets that we're seeing that clients are looking for in this sort of exit surge type environment that we see coming up. The key one is capital efficient growth. So being able to take the capital and the resources that the firm has and grow it while being very lean. In other words, growing the top line of revenue and the bottom line of profit at the same time. Now, why that's super important is number one, if you're gearing up for an IPO, then the way the market is looking at IPOs these days is they really want to see that you have profitability and a way to grow and are not going to be consuming too much cash. The old mode of grow at all costs is out the window. And the strategy today is being able to grow thoughtfully and profitably. And then the other very closely related reason that you want that kind of growth is, of course, if you are readying the company for exit to either another private equity sponsor or a strategic buyer. There, that sort of profit and profitable growth and capital efficient growth is critical.
Absolutely. And I can't underscore enough the need to get executives in chairs that understand the acquisition or M&A process. And a number of clients that I've talked with said, how much of an impact can this executive make in a short period of time, given we're trying to exit these companies? And, again, as a career operator with significant M&A experience, big impact. And to me, it pays in spades, because when we look at these acquisitions or selling a company, it's not only making the company look as good as possible, i.e. maximizing EBIT, but it's creating a vision or a story that the acquirer is going to want to buy into, achieve, and the like. And a skilled expert in that fashion pays off in spades as you start to look at acquisitions. Let's shift gears for a minute, because when I think about the current market, we've got M&A activity at an all-time low. So private equity, new platforms, all-time low. We're talking pre-pandemic levels, but yet executive compensation remains high. Can you tell me a little bit about that and what our findings were there?
Yeah, why do executive compensation packages remain high? The answer is nobody knows. I personally chalk it up to gremlins. No, actually, there are a number of very good reasons that, it's talent is a market. And like any other market, there are the laws of supply and demand. But also, like any other market, there are a bunch of subtleties and complexities in how elastic demand really is. And we're seeing that happen right now in the private equity space. So just for background, about this time last year, the average OTE, the average on-target earnings, that is the cash compensation for executives in private equity-backed software companies, passed the $500,000 mark. So OTE, combination of salary and bonus, passed $500,000 a year. And it's remained elevated above that, even though deal flow and what should be the overall demand of the market has been sharply lower, right? So there are a bunch of reasons. Number one, when you're talking about highly seasoned, highly qualified executives like those we have just been talking about, the ones who can drive M&A, for example, then demand is always going to be high. If you have that successful track record, then odds are good that the demand and the salary, the price for that executive is going to be high. Secondly, private equity sponsors have been up-leveling their leadership teams over the last 18 months or so. Now, we see this especially in any role that touches growth or revenue. So obviously CEOs, but all the go-to-market roles. So CROs, CMOs, chief customer success officers. The demand continues to be high there because they're looking for executives who are able to operate and perform in the market conditions like we have today. Another reason that the salaries remain elevated and bonuses remain elevated is that some executives are playing hard to get. So basically, there's this little bit of risk aversion at play in making a move in the market, especially if you're considering moving to a portfolio company that perhaps has not been achieving its goals or its projections. Do you want to step into that sort of situation? Some executives are being a little coy about that. A couple other factors. Sometimes firms we're seeing are making leadership changes so that they can make a portfolio company more attractive to a potential acquirer. So this may especially be the case when you're looking to sell to another sponsor. Okay. What you're looking to do is show that you have an executive team that has the framework and the fundamental skills to grow it to the next level. And so that can make it attractive to the next PE sponsor. And then lastly, just the depressed rate of exits. We think that has a drag on the natural turnover rate and rate of openings in roles that would be happening in the industry otherwise.
Absolutely. And I think based on our experience in this industry, the data, I don't see this changing anytime soon. And so I think for the best executives, PE firms and their portfolio companies are going to continue to need to pay a premium to get the talent in, for sure.
Yes, 100%.
Well, Boone, it's always a pleasure. Appreciate having you on Tailored Talent today and hashing up what's going on in the private equity software market.
Thanks a lot, Eric. Really enjoyed it and looking forward to next time.